Thank you very much, everyone. Good morning. And thank you, Joanne, for the invitation to speak here today. My name is Sanjay Patnaik. I'm a Senior Agile Fellow and a faculty member at GW in my day job. And today I thought I'd talk a little bit about business strategy in the age of climate change. What does climate change actually mean for business? How can firms respond to climate change? And especially the climate risks that they're facing. I wanted to put up a small graph here that really encapsulates the challenge of climate change for all of us. These are global temperature anomalies from 1880 to 2015. Red and orange means above normal temperatures. And as we see, we're starting, especially in the last 20 to 30 years, once you get to about 1980, to really change into the much warmer regions. It's quite drastic. The temperature anomalies above average are really increasing the last 25 years. And this shows that everyone is affected, the entire world. These are just the temperatures, but obviously the temperature change will have a lot of other changes in the physical sphere that will have profound ramifications for our political and economic system, and no one will be spared. No industry, no economy, no country, and especially for our increasingly global economy, this will mean a lot of challenges. What is interesting about climate change is that it is unlike any other environmental problem. So these two economists put it to a very nice point. It's really unlike any other policy problem. It's almost uniquely global, uniquely long-term, uniquely irreversible, and uniquely uncertain, and certainly unique in the combination of all four. And this will create a lot of challenges for companies especially, and for those companies that don't prepare for it. And so in a project with a colleague of mine in Boston, here, Fabrizio, we've been starting to look at what are the main challenges that will make climate change very difficult for companies to deal with. And the two main ones that I wanted to discuss here today are kind of the risks that climate change will pose and the levels of uncertainty. The risks are really novel because climate change has a systemic nature. And that means it raises the complexity and interdependence of risks. A recent report came out and is also acknowledged by the military that climate change is a risk multiplier. It will make worse a lot of other business risks that firms face on a regular basis and on a scale that we have never experienced before. And similarly, the levels of uncertainty that managers will face will increase to levels that they are not used to. When we have more extreme weather events, when we have more frequent weather events, we don't know when they will hit and where exactly they will hit. So the uncertainty will pose substantial challenges for firms. Let's talk a little bit about the risks. Why are climate change risks becoming more important? The World Economic Forum actually in 2017 mentioned climate risk as one of the major top global risks for companies and the world economy. This is really a switch emphasizing how important climate change will become. The US military recently ordered all its commanders to incorporate climate change into their decision making to make their armed forces more resilient to climate change. And the third development I wanted to put up here is really important. We see a profound shift among investors to push firms to analyze climate risks and to respond to them. Asset management companies in the UK recently that manage about 1.7 trillion UK pounds announced a program that would require all firms they invest in to recognize climate risks and disclose how they will address it. And I think this is really a profound shift because even the shareholders of ExxonMobil recently voted to force the firm to disclose their risk to climate policies and climate change, which is quite ironic, right? And so what we also see is that there is a disconnect. About 93% of publicly traded US firms do face some kind of climate risk, but only 12% disclose those risks. And importantly, if we look on a global scale, McKinsey came out with a report that about 28% of global 100 companies, only 28%, have actually looked at how climate change will impact their business, and only 18% implement some kind of specialized risk assessment. And so this is a really big disconnect between the vulnerability of climate change for firms and between what they're actually doing. And as the managing director of Moody's puts it, there is a real hunger of knowledge among investors of how to assess climate risk. So there are a lot of opportunities, I think, in that space. So what risks do firms face with regard to climate change? These risks are really broad. Obviously, the immediate ones are physical risks, right? Where am I going to locate my next plant? Probably not next to the coastline, or probably not in a way that will be flooded regularly, right? Supply chain logistics risk. If we just look at Puerto Rico right now, Puerto Rico is home to the largest manufacturing base of medications in the United States. They were very hard hit during the hurricanes, and still there are hospitals that don't have enough medications because of that. So we need to have more redundant supply chains. The sourcing of raw materials, right? Going back to the Mars case, this will be critical. A lot of products depend on that. We will have to avoid bottlenecks, right? Energy sources, some energy sources won't be available. We've seen that in Italy when there was a large drought many years ago and hydropower couldn't work anymore. Regulatory risks, which I'm going to talk about on the next slide. Especially after the Paris Agreement, we have seen a large increase of regulations for greenhouse gases. About 80 jurisdictions now in the world have a carbon price, basically regulating the emissions of greenhouse gases and making it more expensive to emit carbon. And political risks. Political risks associated with scarce resources like water and also with migration pressures. I always tell people when you look at the refugee crisis that we saw in Europe in 2015, that's probably nothing compared to what we can expect in the future with the displacement of people in the Middle East or in Africa. And so what do firms have to do? What can they do to mitigate some of those risks? One important aspect will be, and I think that will really require managers to change their thinking, to assess climate risks much more strongly and prepare for those risks. They will have to incorporate that really into their strategic decision making. We already see insurance companies, obviously, for obvious reasons, doing that, as well as finance companies, but we see a broad swath of industries and firms that don't really look at that. And they will have to incorporate climate risks much more into their strategic decision making. So how can firms do that? This is a brief, small framework that my colleague and I have been working on. If you're interested more, you can please feel free to talk to me. That consists of basically 4 stages that we're proposing. A firm first has to identify and analyze the climate risks. A lot of firms already fail in the first stage. They don't even recognize that it's a problem and that they're vulnerable. After that, they should really assess the impact of those risks on their business. How will it affect my location choices? How will it affect my supply chain? How will it affect the cost of my raw materials, etc.? The next step would really be to integrate that risk analysis into the strategic decision making, integrating it with all aspects of strategy and not keeping it separate. My product strategy, what kind of product markets am I going to move into? My pricing strategy, my corporate political strategy, my international expansion strategy, etc. And then the last one, which is really important, is firms will have to take actions to mitigate those climate risks and to exploit new opportunities. It's not only a downside, it's also an upside. And I think there is kind of a lot of potential for firms that move early on that to actually gain a competitive advantage and make their business more resilient to financial and strategic risks because of climate change. I also wanted to talk a little bit about carbon pricing regulations. So carbon pricing is when you put a price on emitting a ton of CO2, either through emissions trading or a carbon tax. And one implication for business will be that emitting greenhouse gases will no longer be free. It is already not free in about 80 jurisdictions, as I mentioned, both on a subnational and a national level and even supranational level. Firms will have to assess their carbon footprint more frequently than they do now. And I believe that those firms that actually know their carbon footprint and can reduce it will be able to gain a competitive advantage. Another important aspect that managers are not used to is to learn how to navigate different regulatory environments with regard to climate change. We see a lot of different patchworks on emissions trading, for example, and on carbon pricing in the world, and this is something firms will have to get familiar with. Another important aspect that a lot of companies are already doing is to use an internal price of carbon to prepare for external regulations. About 400 large companies in the world already have an internal price, and that can really kind of be a test run for managers at all levels to understand how carbon pricing works. And then, this is also important, a carbon price can make some renewable energy sources more competitive because all of us are not really paying the full true costs of fossil fuels right now, right? We need to internalize those real costs. And interestingly, we'll see a real big enthusiasm among countries to pursue, as I mentioned, carbon pricing policies. These will either be emissions trading or a carbon tax or a combination of both. And finally, what firms should expect, at least in the medium to long term, is to expect a carbon price of at least $20 per ton of CO2. That's also what economists say is kind of like the minimum threshold we need to actually induce changes in behavior. To give you an idea, This is a recent map of all carbon pricing regulations that are currently planned or already implemented. And we see a wide variety among developing and developed countries. And China is the most recent one that is currently developing their emissions trading program. And if they make it work, this will really be a game changer. What are some other implications? This is my last slide. Investing. There will be huge implications for investors and companies that need capital. We already see that fossil fuel companies will become more risky, especially if we look at coal companies. Some of the major banks have decided not to fund any more coal projects in the United States, and so that shows that these firms will have a much harder time getting capital. Another one that is also important is that from an investor's perspective, looking at some of these government incentives that exist out there, they can really make new technologies more competitive and less risky and attractive. Another one that we see, especially in the developing world, which is quite encouraging, is that there is really surging demand for alternative energy projects and technology, and this demand will only increase. India, for example, with France together at the Paris Climate Conference, they announced an international solar alliance that is only focused on providing technology and financing for solar projects in developing countries. And they've really ramped up their efforts. And the last point is that environmentally conscious investing is becoming more important. As I said before, investors are becoming increasingly aware of the importance of climate change, and they're shifting towards this kind of emphasis. I wanted to end on a positive note here. We'll talk a lot about gloomy aspects of climate change today and the risks, but there are also a lot of opportunities for entrepreneurs, for investors, and especially for students and graduates that are here in the audience. There will be new ways to gain a competitive advantage. One of the supporters of IGEL, Rubicon Global, for example, which we call the Uber of waste management, they've really capitalized on a new business opportunity that is related to the environment and being sustainable. There will be new business models, new industries. We probably don't even know what we'll have in 10 to 15 years. And interestingly, regulations can also be beneficial for those firms that realize it. If, as a firm, you move early and you reduce your carbon footprint early, you actually will benefit from those regulations as compared to those competitors that are more dirty. And as I mentioned, for the students and graduates here in the audience, you will have a lot of career opportunities. I believe especially in the risk assessment area of climate risks, there should be a lot of important opportunities. All right, this is the end of my presentation. Thank you very much for your attention. If you want to find out more, you can follow me on Twitter or check out my website. I promise I don't do any 3 a.m. tweets. I usually stick to the day. All right, thank you very much.